So this episode is on FHA. So I mean, historically, FHA came out of the Depression. It was like, how can we get more people to buy homes? We've also, over the years, had like an evolution of what FHA loan programs look like. And I'll tell you, 25 years ago when I was doing loans, it was complicated to come up with what's the down payment for FHA loan. Now it's real easy. So I'm going to have Garrett kind of take us through the scenario as we've done before. I'm a real estate agent. I brought you some clients. So you've looked at their financial snapshot, and the best advice for them is an FHA loan. Explain to the listeners why, what would cause you to go in that direction. There's certain indicators. So.
Yeah, 100%. So FHA, Federal Housing Administration loan. So it's a government loan. So just like the VA loan, the government has a piece in this where they're verifying a portion of it. However,
but again, they're not making the loan.
But they're not making the loan. It's just guidelines, rules, and regulations banks and investors have to follow to give you that type of loan program that they've created. Like you said, really the Federal Housing Administration created the FHA loan to provide an opportunity for first-time homebuyers to get into the market with having to put less money down and receive an interest rate that was at the current market or a little bit better than the current market. And there was an add to that, meaning why did they create that? Is because they didn't expect everybody to be able to get to 20% eventually anymore. Not being able to save to that 20% down payment, which is where the vanilla loan that we talk about all the time, the conforming loan, it goes to 20% down, and that was where it was seen as the most traditional mortgage program out there. That's when you get the best types of rate and qualification. Well, the Federal Housing Administration and the government knew not everybody's going to be able to save to that 20% down payment. So they created a loan program that allowed to put 3.5% down. So the FHA's minimum down payment requirement is 3.5%. And this isn't a veteran only or active duty loan. This is for any borrower that qualifies.
And it's not a first-time homebuyer only loan.
Correct.
Also.
It's not a first-time homebuyer loan only. It was just designed for first-time homebuyers because they wanted you to be able to get into the marketplace with 0% down. So typically on a FHA loan, what we look for, right, is a borrower that maybe hasn't saved to that 20% or 10% down mark yet, and they only have assets maybe of 3.5% or 5% or 10% of the total price of the home, and we don't want to use all 10%, right? Mm-hmm. They want to have a rainy day fund themselves, so we look to put less assets down. And the government also understood that if you have less assets, you probably don't have the FICO score requirement that a stronger borrower might have. So they created a limitation to the FICO requirement. Same thing with the VA loan in the government. 620, if you have a FHA loan and you're 620 or greater, you're going to receive the same interest rate roughly, and same type of loan program, 620 or greater. And then below that is when we have to do a little bit more verification to understand your qualification. But right around, I'd say anywhere between 600 and 700 is typically when we are advising of FHA loans if they don't have a large down payment. If they have 20% down and they're around 660, it sometimes makes more sense to be on a conforming loan. But if they're at 660 and they're only putting 10% down, most of the time the FHA loan program is going to be much better than a conforming loan program, even if the conforming loan program is 20% down and you're putting 10% down on the FHA, because the FHA gives you an interest rate that's 0.5% better than the conforming market or the traditional market. They let you put a minimum of 3.5% down if you wanted to. And the only add to that, meaning only qualification that gets added to you, is mortgage insurance. So the FHA mortgage insurance stays on your loan for life, regardless of how much you are investing in your down payment, until 10%. If you put 10% down on an FHA loan, the mortgage insurance on an FHA loan will fall off after year 11. Just a set rule by the government. If you put 10% down on an FHA loan, you take that loan to term for 11 years, because they're all 30-year terms. You take it to 11 years, boom, that mortgage insurance will fall off. If you put 5% down on an FHA loan, Your mortgage insurance is a set standard given by the government of 0.8%. So 0.8% times your loan program divided by 12 for the 12 months is what your monthly mortgage insurance payment's gonna be. And that's set by the government. Regardless of where your FICO score is, you could have a 780 FICO score, you're putting 5% down on an FHA loan, you're gonna have mortgage insurance of 0.8. You put less than 5% down, and let's say you're in between 3.5% down and 5. I know that's small, but some people it still makes sense to just only put 3.5% down, not 5.
Sometimes it's all the nickels you have to rub together.
Exactly. So at 3.5% down, right, you're going to have mortgage insurance at 0.85%. So just slightly higher than getting to 5%, but it is still a little bit more, and that stays on the loan for life as well. So mortgage insurance should not be looked at as a bad thing. I love mortgage insurance because it allows buyers to get into properties now and not miss out on the cost of waiting, because your appreciation run on the property, and by the time you've paid off a lot of that principal loan, that mortgage insurance, if you waited to the moment you saved 20% to avoid mortgage insurance, well, you'd be waiting a lot longer than the appreciation you might have gotten on the home, and you can refinance out of that mortgage insurance.
Right,
eventually.
right, and or you've got priced out of the market.
Correct, and now the price of the home is continuing to go up.
You're always just chasing the market.
Exactly. So the FHA loan, Federal Housing Administration loan, really was designed for first-time home buyers, but everybody uses them, not just first-time home buyers, because you do have to buy it as your primary residence. So if you do already currently own a home, and let's say you wanted to keep this home and buy another one, and you only qualified on an FHA loan or wanted an FHA loan, you'd have to move into that property. You'd have to buy that as a primary. The government requires you to buy that home as a primary residence, not an investment. But if you find a duplex or a triplex or a 4-unit property, you can buy a 4-unit property with an FHA loan at 3.5% down. You can use the rents on the other 3 units to help you qualify for that home.
Yeah.
So there's a lot of options with the FHA loan because there's a little bit more lenience with the underwriting because it's protected by the government a little bit more. Your debt to income ratio, it can go a little bit higher as well. And you're allowed to put the minimum down comparative to other all loan programs. So it's really, really a good loan option until your FICO score gets to about 700. If your FICO score is about 700 or greater, there are now other investors like the conforming just traditional market, or there's other private investors in the jumbo space sometimes too that have now created better loan programs than the FHA loan program. And so that we typically see start kicking in right around a FICO score of 700 or greater. You're most likely staying away from FHA. You're 700 or below and you don't have 20% down, you're most likely going into FHA because that'll be a better option for you in the overall cost and the amount you have to bring in as your investment.
So in generally speaking, debt to income ratios on FHA, and this is an FHA, we're talking about the numbers, by the way, and the numbers are important, it's the 203B.
Yes.
That's their version of the plain vanilla V. That's your base model FHA loan.
Yep, 203B FHA basic loan. Yeah, that debt to income ratio typically, max I've ever seen that pushed is about 56% in debt over income ratio. And remember, debt, all your monthly payments on credit cards, auto loans, student loans, personal loans, plus the new housing payment divided by your overall income gives us that ratio. And we can keep that typically on FHA below 55% and get you an approval. And so same thing like we were talking about, kind of segue into where I think you'll want to go with it is where same thing, you qualify the borrower with the credit, the income, the assets of verification for FHA and meet all their cool guidelines. You got to do the same thing with the property for FHA. Remember when we were talking about your appraisal examples in your appraisal video, the underwriter will verify the appraisal, right, directly to the type of loan program it's going to require. And so the FHA 203B appraisal does have specifications that it has to meet. Double strapped water heaters in California, right? Lead paint can't be peeling and you gotta go repaint that. Can't have termites. Gotta have CO2 directors. You knew exactly where I was going with that one. So we have to meet certain things, and the underwriter is going to confirm and make sure that that appraiser verified that we met those exact requirements for that 203B appraisal or that 203B loan, sorry. If you don't, let's say the property doesn't, right? Let's actually go quick. If it does, boom, stamp, clear. Met all those, we can go FHA loan, right? We verified it and you're good to go. Let's say though, most homes are de-stressed right now, right? We have a lot of old homes here in San Diego and LA, and we're not meeting the same types of property qualifications because the paint is peeling, or the property's been around for so long that the termites are there, and we got to get termite clearance, meaning you got to go tent the home potentially. Or let's say there's a cracked slab in the foundation, and you know, cracked slabs are really difficult to get around, because if there's a crack in the foundation, that's typically no bank or lender is going to want to lend on that, because that home has a much higher likelihood of failing in the future than it does your neighbor or anybody else. So most lenders won't even lend on a cracked slab, except for the FHA. The FHA has a renovation loan, and that's called your
203K.
203K loan. And that loan is awesome because multiple things can happen. You can buy a de-stressed home that's in terrible condition right now.
To a limit.
To a limit. Yeah. Has to meet some type of health and safety, but let's say there's a cracked slab, right? And you cannot get a normal loan or even a 203B with a cracked slab, but you can get a 203K with it, because what a 203K renovation loan does is you would work with a general contractor to generate a scope of work of what you would want to do with your agent and yourself on your property. Maybe you want to clean up these doors, clear all that termite issues, clear any types of health and safety issues on the property. We would tell the general contractor, put in a scope of work for fixing the cracked slab. Maybe the kitchen's out of dated too, and you can get the kitchen updated and renovated as well. Whatever that might be, you get
basically do your own flip for you.
Correct. You're doing your own flip for yourself. You'd get a general contractor in, give you that scope of work. Now we take that scope of work from the general contractor and we give it to the bank. The bank is going to approve that general contractor, make sure that they're approved to do that work in San Diego, make sure they're approved to do that work with the bank. Then they're going to give that scope of work to an appraiser, and they're going to say, hey, this borrower is going to do a 203K loan or an FHA renovation financing loan. And that appraiser is going to get the scope of work from the general contractor of all the renovations and the fixes that they're going to do to make the property health and safety for the lender, us. They're going to take that scope of work, appraise the home, take the comparables that an agent will bring them as well, and they will give us the after improved value, meaning based off of where the current market is, plus a little time consideration for the work that'll need to be done, plus all the work that will be done, they'll give us that value, the after improved value, to purchase the home. So let's just say, quick math, you bought a home de-stressed right now, it's not looking too good at $600,000, but you are gonna put in $100,000 worth of work. Boom, you can go to $700,000. If we show a good scope of work to an appraiser, they're gonna go, yep, the value is right around 600. The general contractor is gonna do about $100,000 worth of improvements here. Boom, we can get we can lend on a $700,000 property.
If the appraiser can project that with those improvements, this house would be a $700,000 house.
Correct, exactly. Don't just go buy marble floors.
Right. Yeah. You can put a lot of money into a house that will not raise value. Trust me.
Yeah.
I've seen a lot.
But the cool part about the 203K loan or that renovation financing loan is that you're buying a de-stressed property, you're able to build it the way that you potentially can and want to, right? Like you would rent it with the kitchen remodel, the updates, the fixing of the foundations, whatever it might be. Let's say that's a scope of work for 4 months or 5 months. You don't pay a single payment on that mortgage until that house is done being built. So for the 4 months that it takes, we're gonna close on day 30 roughly, and it might take 4 more months. Escrow is gonna hold all the funds that were for that builder and for that general contractor to do all the remodels, and you'll never make a mortgage payment on that mortgage until until that home is done and you get keys to move into that house. That's when your mortgage technically will record and start.
Yeah.
Very cool.
It's a really impressive program, and especially in a time where, I appreciate these in times where markets stabilize, and now in a super hyperinflated market, if you got four walls and a roof, you're selling the house. You don't have a problem. Now, people sit on the sidelines a little bit more. The marketing time extends a little bit more. The things people were willing to overlook, they're not overlooking. So now's the time that a borrower can get in, as Garrett describes, turn it into the house that they really want, provided they qualify for that future price, provided the appraiser feels it'll be worth that, and they're willing to go through that. Some people aren't willing to go through that, but they are. A lot of people love HGTV. They're excited about doing something like this. So this is kind of an HGTV friendly loan to get them a house with a very low 3.5% down off of 700,000, right?
Yes, that is a perfect way to describe it. An HGTV type of loan. I love that.
Yeah, you can steal that.
I was going to say we should start calling it that.
You can steal that one.
Yeah, I like that. That's what I'm going to say next for sure on the phone.
So a couple other key things about FHA, as I recall, is first of all, where plain vanilla, a conventional conforming loan, they have some very strict standards, especially about credit and about income. In the past, I've always found FHA could have a little room for gray area. Yeah. For instance, let's say someone doesn't have a lot of credit built up. They just live a cash lifestyle, which is not a bad thing unless you want to buy a house. So you can usually document other forms of credit, right?
Correct.
How well do you pay utilities?
Yep, absolutely. So we would so conforming has what's called a trade line requirement,
which means a car payment, certain number of credit cards, a student loan. You got to have a certain minimum of those.
But all of this is changing even as we speak right now, rapidly. So technically now, conforming and FHA and VA don't actually have trade line requirements. They have just history requirements. So if, let's say, you don't have an open or active credit card or an open and active loan, but you had one in the past, we can still run the desktop underwriter or the automated underwriting system that would still give an approval based on your old trade lines and things like that. Conforming is a little bit more strict on that. So that's where Kevin's saying, hey, the FHA is a little bit more lenient. They allow you to get away with a little bit less qualifications. That's why it was designed by the government to allow you to go to 620. That's why between 620 and 700, FHA will be better for you most of the time, because they'll provide, they'll give you a little bit more lenience on income of qualification. They'll give you a little bit more lenience on credit if, let's say, you have a derogatory payment. Let's say you have a medical collections account. the government's not going to make you pay back the collection account for your medical bills on a government loan. Conforming will only let you not pay back up to $2,500. If you have a medical bill that's derogatory on your credit report for $10,000, conforming is most likely going to make you pay that off on the automated underwriting system before giving an approval. FHA, a little bit more lenient. They're going to just say, yeah, we see you have a $10,000 medical bill coverage. We understand your kind of lifestyle and your abilities. You can, eventually make that payment back. You might not. FHA will still give you that approval. Yeah. So there's a little bit more lenience there.
Kind of like if dad says no, go see mom. And mom in this case is FHA, both on income, documentation, qualification, and so forth, and credit. So that's key. And then obviously, just generally speaking, you don't have to have sterling credit to get into FHA.
Correct. The other one, though, real quick on that piece, is FHA is actually a little bit tighter when it comes to self-employment, though.
Oh, okay.
So that's a really cool one to know is FHA, because it's a government entity, right? They're a little bit closer to the whips of the IRS.
Right.
So if, let's say you're a self-employed borrower, on a government loan, you got to pull transcripts, meaning we got to verify that you filed your tax return. It matches the return that you filed. Then we got to confirm with the IRS that the IRS received the exact return that you showed us, and then boom, we can move forward. We actually don't necessarily need to go that deep of a dive on a traditional loan because it's not a government loan. So when it comes to income and self-employment, just like in our other talk before, the IRS is very involved on government loans, especially if you're self-employed. But if you're self-employed by a family member, it's even tougher of a dive. You've got to dig in deeper to confirm that you didn't just get an updated salary from dad or mom to go purchase this property, that you've earned it over a consistent period of time. So
Yeah.
FHA self-employed will do a deeper dive because they're tied to the government, and the government is the IRS. Conforming traditional products won't do that big of a dive on a self-employed person. That's the one caveat to FHA.
So one last thing, in the past, FHA, again, from a broker standpoint, I got a conventional offer and a FHA offer, and my first thought is the FHA loan's going to be harder. The property qualifications are higher, and it's going to take longer. What are you experiencing with FHA as far as processing time, as far as appraisals
and all that? Same thing for appraisals, right? We all appraisers are following the same standard of rules, regulations, and guidelines. They just have to appraise the property slightly different to that type of loan program. So an FHA appraiser, right, is also typically your same conforming appraiser.
So the appraisal, and again, sorry, because I've been doing this so long. In the old days, I'll tell you, in the old days, they were, they had like a lot of minimum property standards that had to be met. Do they go through that same thing? And I'm thinking things like trip hazards, broken windows, peeling paint, roof condition, and things like that, where they would call out a lot of things. Is that still part of the FHA appraisal?
Yes, to a degree, way less than it was back then.
Okay.
Because now it's just a simple blanket statement. Do you meet health and safety section 1? Do you meet health and safety section 2? We can go into a lot of deep dive on that, but what that really just means is if you can meet health and safety standard 1 and health and safety standard 2, boom, you are cleared to go on moving forward on any type of appraisal FHA. FHA, though, will look for certain things. For sure, termite, because government, and this is kind of the same with VA, but FHA is going to look for peeling paint on the property. So any type of peeling paint, if it's peeling, FHA is going to want you to go repaint that up, even before you buy the home. So either you got to get a repair person to do it before you purchase the home, or get a credit, and we could potentially sometimes close the loan, depending on the circumstance, close the loan, guaranteeing that and you'll show us pictures afterwards, that you'll go get that painted within a week or two.
Yeah.
And they will check up on that. So that's it. That is a verification. Other things would be definitely termites and any health and safety. So if there's tripping hazards that could absolutely cause a personal injury or liability, then they'll call that out in the appraisal. And then it'll say, hey, tripping hazard moving from master bedroom to blah, blah, blah. You need to get that shaved down, or whatever, that curb thing that was the tripping hazard, right?
Yeah.
Get that cleared up, and you might have to get that repaired. And then the FHA, right, is going to make us verify that you have done that repair. So we got to get a 1004D, which is the re-inspection of the appraisal. The appraiser's got to go back out there, or sometimes we'll allow for the listing agent or the seller to take a picture of the repair work, send it back to us. If it's very clear and concise, we can just pass that on to the underwriter and the appraiser. They'll fix up the report, and boom, we can get that clearance. So FHA has a little bit more of minimum standards they got to meet in that appraisal, but same thing that you should expect. If you hear somebody say, I don't want to buy, or I don't want to sell because they're FHA buyers, because I'm afraid that the appraiser is going to ruin it for us, or the appraisal is going to ruin it for us. Wrong. Don't think that we all have the same set and standard. The FHA is just looking for a couple more pieces, because we have to make sure that on the loan side, those things are taken care of. But every appraiser is going to look for them and call those things out.
Yeah. So again, so I'm trying to give you a little bit of history here, just so if you get out in the market, become an agent, and someone gives you that response, I don't want you to be stymied to go, oh my gosh, is that really the case? Well, not necessarily. And to a large degree, you need to kind of go into properties with, if your clients are FHA buyers, you need to go in and go, oh, I'm not sure if this one will meet the criteria. You might want to avoid that one.
Yeah.
Or, because the minimum lender repairs, it's part of the contract, and the seller's not obligated to do it. We can ask them to do it, but they're not obligated to do it. So you could be doing a lot of work on a property that's not going to go forward.
100%. And to add to that, the appraisers that we use here internally on our team, right? Our appraisers, each appraiser that does conforming does our FHA appraisals as well. So they know the exact standard that they got to meet for conforming. They know the exact standards they got to meet for FHA, and they're appraising the properties the exact same way when they go out to them. So that's why we can confidently tell you the values that you'll get on conforming, FHA, jumbo, VA should all relatively be identical, and you should not be fearful to accept a VA or FHA offer ever.
Right. So, well, outstanding. So that's FHA. Remember, 203B is the basic one. 203K is the renovation loan. And real quick, there's two versions of 203K, right? Is there a light and then under and over 35,000?
203K Streamline and 203K Unlimited, I think. 203K. It's called 203K Streamline is the one where we can only lend up to about $35,000 past that approved value. And then I think it's FHA Unlimited. Don't quote me on that. We'll go back to it and confirm, and Kevin can tell you. But it's the two programs. One lets you go up to there's actually three, but one lets you go up to $35,000 only on that approved value. Get a different type of qualification for that, and then there's an unlimited portion that you can go up to in that future improved value as well.
Yeah. So so again, a lot of the homes that your clients might be looking to buy won't need a new kitchen and new this and new that, but there's going to need something. Let's say there's no operational bath. Okay, well, so let's say that's a $10,000 problem. They can get a $10,000 loan to make this happen through the loan. So
be on the Streamline one. It'll be a little bit faster of a qualification, faster of a timeline because you're not using as much just the 35,000 or 10,000. But the moment you need to do a kitchen, a bathroom, and some other things, you've gone over 35,000 most likely.
Right. Real easy. And the other thing is, remember, I get this question asked a lot. Well, can I do the work myself? No, you got to have a licensed general contractor, licensed by the state of California, in good standing with bonding and all that. So as you said before, it's got to meet those things. So
correct.
So the old sweat equity part of it doesn't come to play here. It can come to play on repainting or doing certain things, but if you're going to fix the slab or put in the new kitchen, no, we need
contractors,
licensed contractor to accomplish that. So
that would be interesting to know too. If I've never been asked that question. If you are a general contractor, you're licensed to do it, can you do your own property? My assumption, let's say you have your own general contractor company, right, and you could do it with all your builders. My assumption would still be no, because it would be a conflict of interest that you're the general contractor of your own personal purchase. I would think the government won't like that.
I think it would sure get it muddy pretty fast.
Yeah, exactly. So. Well, cool.
Okay, good.
Thanks, Jeff.